Hey guys, so welcome back to another video on Trade Now, and as you guys can see from this video title, I will be showing you guys 3 indicators that will help you to determine your stop loss and help you to learn how to risk manage with your account. So what do I mean by risk manage? Is basically by limiting your stop loss to the lowest amount and trying to maximize your take profit. So basically, when trading, a lot of people do not know where to put their stop loss, so hopefully these 3 indicators will help you to determine your stop loss, ensure that you don't get stopped out by the wicks, and help you to win those trades while keeping your losses as small as possible. But of course, before we start this video, make sure to check out the link in the description box below. You guys use that link to sign up for a FedEx account and you deposit money inside. For each $100 deposit, you get an extra $5. So it's an extra 5% gain on the account by just depositing. So just check out the link in the description box below, get low fees for trading crypto, and yeah, let's get on with the video. So first and foremost, I'm going to bring you guys the most popular and basic simple indicator that will help you to determine, which is your average true range. So this indicator is very good because it helps you to show the different volatilities in the market. So as you guys can see, when there is high volatility in the market, you see there's this big red candle here. You can see that the ATR value is high, and when there's low volatility, like right here where you see that price is relatively basically quite flat, you can see that the ATR values are relatively lower. So basically, I'm going to explain to you guys how does this work and how you're going to use it. So ATR values are the average of the candle size. So basically here, let's look at maybe this area right here. We look at the ATR value. The ATR is 7.6. so this means that in the past few candles, so in this case here, you can see that the length is 14. That means it means that in the past 14 candles, the average movement of one candle is 8.4. so this helps you to tell the volatility in the market. So you usually don't want to have a fixed stop loss, because let's say right here, if you are having a stop loss where it's here, you might have having a stop loss that is too big and you might get stopped out. But and same thing here, maybe you want to enter a long position right here, and you want to have a very small stop loss, maybe right below the candle. You can see that you get stopped out. But let's say you have a very big stop loss using the ATR value here, because there's more volatility in the market. You can see that you can still have a very high risk to reward ratio, and it really just depends on the volatility in the market. So let me show you guys how to use it. So first up, you really want to determine what is your most comfortable ATR value and your comfortable loss ratio. Usually I would recommend either a 2 ATR value, 2 times of your ATR value, or maybe around a 2.5 times. So let's say we are trying to take this breakout right here. You can see that we have a breakout to the upside. This is sort of a small resistance area. So let me draw that. You can see there's a small resistance and we are breaking up to the upside. So we want to take that breakout. And here we want to look at the ATR value on this candle. We're seeing around a 6.9. So we're going to use a 2 ATR stop loss. So that will give me 14. And we can take a 1.5:1. And there we have a win. You can see that, let's say if you place our stop loss below the resistance, which is now become support, you can see that we immediately get stopped out. But since we are using the ATR value, which I recommend 2 ATR, which is quite comfortable for a lot of people, you can see that we didn't get stopped out. It pulled back and it went up to hit our profit target. So ATR values, you guys got to test it out. Definitely on different time frames, the ATR value is different. So let's look on the 1 hour time frame. You can see the ATR value is around 20 right here, and maybe normally around 14. But if we look on the 1 minute time frame, let's check it out. You can see that the ATR value is relatively stable and it hovers around 1.5. So maybe on the 1 minute time frame, you want to use 5 times of the ATR, and maybe as the higher time frames you go, you want to use a lower multiple of the ATR value. So that is your first indicators that I'll recommend. Next up will be your order block finder. So this order block finder is basically areas where you want to identify support and resistance. So let me see right here. You can see that I'm gonna change the color scheme to bright so that you can see easier. It doesn't really matter, but let me show you guys an example right here. So let's say we want to enter a long position right here. So we have this area where we have a breakout. We kind of have this small resistance here. We tested it once, tested it twice, and we broke up to the upside. So let's say we're going to take this position to break out to the upside. You can see that we have this new formation of the bullish order block. So let's replay it in real time. You can see that there will be a bullish order block forming. So here we have a new bullish order block forming. So it just means that this area is an area where there's very strong buying support. So bearish order blocks is when there's resistance, bullish order blocks is when there is support. So we're going to play the candles out. We have this breakout above the resistance. We're going to take this position there. Usually we want to put our stop loss below the bullish order block because this area is where there's support. So maybe if the price reverses back to this area, there will be a lot of buying pressure and you push it back up. So you can take a 1.5:1, and let's see, indeed pull back to around this area right here. You can see that this is the area where the bullish order block is forming. Pull back and you hit up. As you can see, the stop loss really played to our favor and it didn't stop us out. Let's say we're going to put it very low, right below the recent swing low, which is right on this candle there. You can see that we'll get stopped out, but if we put it below the bullish order block, you can see that we'll be hitting our take profit right there. So very easy to use. You're just going to place your stop loss right below the order block. So let's say you enter along there, you're going to just place it right below the order block and you just have a 1.5:1. So it helps you to bring greater value to your trade because places of support are where you want to buy, places of resistance are where you want to sell. So usually these areas are where there might be helping you to follow your trend and helping you to increase your trend win rate. Same thing for the bearish order block. If I can show you guys there, let me find an example. You can see that here we have a formation of a bearish order block and we can see that there's a lot of price rejection around this area. Although it went up, you can see that you can have more time for price to reverse back down, and you can exit your trade if you see that the trade is not going in your favor. So this is one of my favorite indicators that I use for my day trading as well. So make sure to try to learn how to use it and basically identify your support and resistance level. Which brings me back to the last indicator, which is the support and resistance channels by Lonesome. Let's click on the first one. So what you'll see is this support and resistance, and it's very clear. Green is support, red is resistance, and what you want to do is basically place your stops below the support or above the resistance. So let's say we are entering a short right here. Let me try to find a proper example. So let's say we're entering on this breakout below the support, the resistance. You're going to place your stop loss slightly above the resistance, not on the resistance line, and you can take a 1.5, although reverse back. It's basically areas where price might reject and head down in your direction. So I'm going to show you guys the long side of this, and this is a better example. You can see that we have this sort of rejection area, rejected, and we have a push back up. So we're going to take that position, take that breakout right there. So we're going to have a stop loss right below the support level. You can see this support level is previously identified, and we're going to place it right there, and we have a 1.5:1. As you can see, price pulled back into this area where the support is, bounced off the support perfectly and went back up. So usually you want to just place your stop loss right below the support, and we are entering short, same thing. You just want to place it right above the resistance here. You can see that we have the rejection of that area. So very nice to see these levels being respected. You guys can use it for your own trading as well. You can see that price went down here. If you imagine you just bought at this support, and you can just have a quick 2% gain, but obviously you cannot just keep buying at support and resistance. Let's say you always sell at the resistance here, you can see that there's a break above. So definitely you can use this for you to determine your stop loss, ensure that you don't get stopped out so quickly. And you guys might be wondering, why is my stop loss strategy wrong? And you guys can use this indicator to try and find out what can you do to improve your stop loss, and really plays a big part in determining your trades, your win rate, your take profit, and how much you lose, which is you want to minimize it as much as possible. So that's it for this video. Hopefully you guys enjoyed. I'm pretty sure this is a very good session for many of new traders, because you learn the importance of having stop loss as well. Hopefully you guys enjoyed, and see you guys in my other videos.